I'm Dan Fitzpatrick. Welcome to the Fitz Factor. Today, I'm starting a new series called Trade That Stock with Scott McGregor and Rocky Cleburne. Each time, we're going to cover one stock with 3 different ways to trade it. Now, this is for educational purposes only, so if you're placing a trade, it's at your own risk. That means that I don't want to hear you gripe if you lose money, and I don't want to share your profits if you make money, all right? Let's get started. Okay, everybody. Dan Fitzpatrick here with Scott McGregor and Rocky Cleburne, our 2 resident swing trading experts and option trading experts, respectively. And what we're going to look at today and trade that stock. And by the way, this is the very first edition of this. So if you like it, let me know. If you don't, then don't let me know. I'm kidding. Well, go ahead and let me know and tell us what we can do better, because this is for you. It ain't for us. So anyway, today we're going to talk about Tesla. And this is the way I see this stock right now. I'm showing my my daily chart of Tesla, and you can see this in a prevailing downtrend. The low is quite a while ago, I think. Hey guys, when did I say this stock could go to $100? Was it at 200 or something?
I think it was around that 180 level.
Yeah, 170 to 180. Yep.
Okay. Yeah, I mean, that was just kind of my downside target on this. And it's not because I don't like Tesla. I mean, hell, we're buying one. It was just simply looking at the chart and seeing this looked like a trajectory of a missile that kind of ran out of fuel and is now heading lower. And one thing that a lot of people don't know, but they'll know soon enough, is that the biggest leaders in the last bull market, and I'm talking about stuff like Tesla, ARKK, NVIDIA, some of these others, Amazon, blah, 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 blah. The ones that really, really scream, like multiples, when they turn over, there's a statistic that I found to be very useful and also very informative. And that is that 50% of those stocks would actually fall 80%. They'd lose 80% of their market cap. That's half of those big, massive leaders. And 80% of them would actually fall to 50%. So there's only 20% of these big leaders that aren't going to take these huge corrections during the next bear market. And I don't really think that's tradable, but it is knowable. I think that you gotta realize what's happening here with a given stock. And right now with Tesla, the bloom has kind of come off the rose, as they say. I don't know who they are, but that's what they say. And I want to talk about why. A lot of these things are really well known. Sorry, I got to turn off my phone. Elon's calling, wanting to know if he can join my podcast. I said, like, hell no, dude, you're controversial these days. Anyway, so there's a lot of things going on, but I think the main deal is the analysts, the way institutions work, they have these analyst departments and they're supposedly the smartest people in the market, not. But the way their estimates work is they see, and there's nothing wrong with this, there's everything right with it. What these analysts do is they'll see a company that is really growing. They really like this. They really like this company. Whether it's Tesla, whether it's Zoom, whether it's Netflix, any of those stocks that, way back a few years ago they were under the radar, like nobody's really looking at them. Well, institutions and everybody really, but we're just talking about the big elephants. Institutions look for these kind of overlooked companies that they think are really going to do well. So they'll have these analysts look at them and they'll say, crap, you're right. I think this thing's really going to go. And so they will base their price targets on their estimates for what the growth is. Hey, we think this company's, we think their revenues or their earnings are going to go up by, 80% next year or 100% next year. Therefore, our price target on a $50 stock, I'm generalizing here, there's a lot more to it. But our price target on this stock, it's $50 now. Our price target's $100. Again, I'm just using round numbers and just simple math. And so then the company goes on, the stock starts moving up. They got a $100 price target. And then earnings start coming in, and well, hell, it looks to me like they're actually going to grow 120 or 150%. So they raise the price target even more to say 150 bucks, and the stock keeps going up, and the same thing happens. Well, so what's really happening is analysts and then hence traders are chasing the stock higher. They're chasing the fundamentals because it's like, gosh, could things get any better? I don't think. Well, hell yeah, they are getting better. And so then they keep bumping their price targets up, and it's a little bit like the Fed, to where everybody always says the Fed overshoots. They overshoot to the upside, they overshoot to the downside. And the reason is, I'll give the benign reason, is because they're basing their decisions with respect to quantitative easing and Fed funds rate and all that. They're basing their decisions on prior data. Like there's no such thing as future data until you get into the future, and then it becomes present data. So they're basing the Fed is saying, we're going to do this. We're going to jack 25. We're going to jack 50. Why? Because they're looking at last month's or last quarter's numbers, employment, et cetera, et cetera. And then they estimate the trend. And, that's all well and good until things start changing immediately, but they don't see it for a month or two or three. Meanwhile, their estimates are for this, while the economy is doing this, and they only figure it out later after everybody's living in tents and crapping in the streets. And then they say, well, maybe we need to stop raising rates for a while. Okay. Analysts are like that. Fundamentalists are like that, where they have to keep chasing the stock higher, which is why you see analysts, you see firms, you see whoever's talking about this, they raise their price targets. They say, crap, it was $100. We got to go 150. We got to go 300. We got to go 1,000. And so that's all fine until the stock starts tapering off. And what they wind up doing is continuing to raise their estimates. Then what happens is, after the stock starts moving lower, these analysts, they lower their estimates, but they still say it's a buy. And why are they doing that? Well, because they want to give their clients time to sell. So people that still say, oh, it's a buy, they're going to sell it, even though the analysts are dropping their price targets. And why are they doing that? Because they're having to chase the stock back down, but at the same time, they want to maintain some kind of credibility. And it's this type of dynamic, which is why when you see the last bull capitulate and say, okay, you got to sell this stock, now it's time to buy. Same thing on the upside. When you see the last bear talk about Tesla, in this case, is worth $20, and they finally say, you know what? No, I think it's worth 450. That's when you got to sell. And so that's really what I'm looking at with Tesla is, as far as the trend on the chart. You can look at the weekly chart, and the stock peaked back in late 2021. And at one point, just a few weeks ago, when it hit the low, it was down 75%, hence establishing that 50 go 80, 80 go 50. Is this going to ultimately fall to 80% down? Who knows? I don't know. I just bought a little bit today, and I'll probably sell it before you watch this, though I'm day trading it. Anyway, but this is what's happening with this stock. I wouldn't be buying this stock right now as a longer term trade simply because the trend is down. This is still printing lower highs and lower lows. And did the stock rebound off of 100? Sure, but it's overbought now. And you can see this in stochastics that I'm showing. And so on the way up, overbought stochastics are actually a good thing. Like if you look and see where it was back in the latter part of, or the middle part of 2021, stochastics were virtually always overbought and the stock started it just kept going. But then when a stock is trending, so it's buy this, stochastics are up, I got to buy this stock. It's awesome. But then when the stock starts trending lower, these overbought stochastics tell you it's actually time to sell. It's actually time to sell the stock. And this is why this one indicator doesn't fit all. Everything is a little bit different, but indicators are for another day. So as far as my preferred type of trading, I wouldn't place this trade. I wouldn't buy the stock right now. I would wait for it to, it's probably going to take, a few months before it might start looking good to me. And I don't have any sense of where earnings are going to be. It's not what I do, but from what I see, just based on where the 50-day moving average is right now, it's about 157, 156, something like that. If the stock runs from the 131 where it is now, that's probably where you'll see some selling. So that's kind of your upside. Now, Scott, before I ask you for a swing trade, if you have one, by the way, I don't know that I said it, they report earnings on the 25th. That's just 5 days from now. And that's why I look at it and say, unless it's for a short-term trade or just an earnings trade, it's not something that I would do. But let's look at the fundamentals. And this is from MarketSmith, just to look at theirs. I use this a lot. By the way, they're not sponsoring this, but I love them, and I'm going to be on IBD Live. I think it's on the 3rd. They're going to start scheduling me more regularly. But as we look at this, the first thing that comes to mind, the first thing that pops out is this stock is only outperforming 4% of all the stocks in the IBD universe, and it's a big ass universe. So just from a pure momentum standpoint, there ain't nothing here. As far as the EPS rating and all these other things, I don't really look too much about at that. The growth rate is 0, but this is a 3 to 5 year smoothed average, and so that doesn't really matter to me now. But what happens is, if you look up here in the upper left-hand side, you'll see that in 2022, the estimates are for $4 a share, we'll say $3.99. That will become apparent whether that number was hit when they report fourth quarter earnings. But that's a 77% increase over the prior year. Okay, well, that's a pretty good deal. But I mentioned a while back, and a few people took me to task on Twitter. I said Tesla has declining fundamentals. And of course, all the know-it-alls who have been trading for 4 years in nothing but a bull market know more than me. And maybe they do, but not in this case, because my point was this. So let's say earnings are going to be 77% higher than the prior year. Awesome. However, what was 2021? 2021's earnings were $2.26 a share. Okay, well, that's pretty good too. But 2020's were 75 cents. And so 2021 was a massive breakout year for Tesla. Now, think about what I was saying with respect to to analysts. During that breakout year from 20, and by the way, in 2019, they were 1 penny. And so this company in 2 years has gone from 1 penny up to 226, and then possibly this year to 399. Can you imagine how these analysts have to keep raising their price targets to catch up with that? So 77%, when you're looking at the prior few years, is not good at all. Frankly, it kind of sucks. But if all you're looking at is what the raw number is, you think this is awesome. What are the estimates for 2023? Well, they're only estimated to grow 21% from this $3.99 a share. And so these fundamentals, while the earnings, and this is a measure of earnings, while the earnings are still growing year over year, this quarter relative to the last quarter, while they're still growing, the rate of growth is declining. So the big money, the institutions, the ones that actually move the stock, this is not the kind of thing that they're looking to buy. They're looking for the next Tesla. And so they're distributing this stock that they've held for Lord knows how many years while their analysts were bumping up the stock. And so what we see is actually declining fundamentals. They're deteriorating fundamentals. It's like they're good, but they're less good than they were. And when they were good before that, they were excellent. And so you've got these declining levels of good. And that's, in my view, responsible for why the institutions are not snatching up this stock. And I won't go into detail on the earnings, sales, and the margins because they're all, kind of relatively benign. So I would just say, and Scott, I want to know what you're saying, what you have to say with respect to more of a shorter term swing trade if you have one. But I've just kind of given you my thesis as far as why I don't think this stock is going to be an outperformer. Has it hit a bottom? Seriously, think about this. Who cares? Why do you care? Because if you're not looking at this stock as being the number one place for cash that you have, then the only reason that you're trying to figure out if the stock is bottomed is because you want to be right. And being right does not make you any money. Following the trend and being able to sell for a higher price than a lower price is profitable, but you're forgetting about the time lag. If you have to hold a stock that you're buying here at 130 and you have to hold it for 2 days to sell it at 150, that's awesome. But if you have to wait 12 months to sell it, that's not so awesome, even though you find, you ultimately made a profit on the trade. So you can't forget about the x-axis, the time axis of a stock. How long are you holding something? And so it's going to take a while for all of these things to kind of work their way through the garden hose. But on just kind of an anecdotal level, this is also what I see. They've cut prices in China, and my wife has been really amped up to buy an X, those things with the Falcon doors and all that. So she's been Scott, I've been talking to you about this for how long? We're going to buy one, and then I don't think we're going to buy one.
Well, I think you waited a while, but I think you waited for the right reasons, and now you're saving money on that buy. So I don't think that was a bad decision to wait.
Yeah, and I mentioned before we were gonna buy a Plaid, which was a lot more money, and I'll be honest with you, we're actually leasing it, and there wasn't that much difference in the lease payments for a regular X versus a Plaid, and we stopped to look at one. This is ages ago when I first told you, well, I guess we're getting a Plaid, and the interior was better. Like they just had better. I won't go into details on it, but the interior on the Plaid looked a lot cooler. And so, okay, what would be the difference in? Okay, fine. Happy wife, happy life. And so then we just went to look at it about a week ago, or a couple weeks ago, because we're back on the Tesla. I had been saying, well, why can't we buy something else? I've already had a Tesla, and the freaking build quality sucks and blah, 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 and all that kind of stuff. But we looked around at other EVs, and, we want to be as green as possible because we're virtue signaling. And so we just decided that Tesla was the best one. because it's easier for the dogs to get in and out. And that's actually a true statement. So we went back and looked, and they'd upgraded the interior of the regular X. And so the only thing that we were buying was like half a second from 0 to 60. I think in the Plaid, you can go 2.8 seconds versus 3.5. And frankly, I don't really think we're going to feel much of a difference in that, because no matter what you're doing, it's still fast as hell.
Exactly, especially if you're just, driving to the Circle K or something like that to pick up a jug of milk. You're not, you saved 1 second so that you could wait in line.
Well, there's that nasty thing about the whole speed limit deal, and
also that.
Yeah. And the cops, all these counties really do need money. And so this is an aside. About 6 months ago, I got stopped for speeding by a motorcycle cop, really nice guy. And I pulled over, which you want to do. And I said, like, dude, how come you stopped me? Everybody was going the same speed. And he said, yeah, I know, but I had to stop somebody, and you were just the one that I saw, and I'm going like, really? It just really boils down to that. Okay. So I went to traffic school, and now I can honestly say I haven't been stopped. So whatever. But anyway, so we're not going to have that issue with Tesla, because ain't nobody going 0 to 60 in 3.5 seconds unless you go off a cliff. So even then, I don't think it would go that fast. So what I'm looking at, though, here is when we went in, we could see 3 different salespeople in the showroom. There was nobody there. Then Elon says, well, we're dropping the price in the US as well. We went in this last week. We couldn't get anybody's attention. Couldn't get any coffee from the coffee machine because it was out. And so my suspicion is that on the earnings call, you're probably going to hear some talk about how interest is picked up, et cetera, et cetera. But I still wouldn't buy the stock until the chart tells me to. So that's my take on Tesla. And the short story is, would you buy Tesla for an investment, Dan? No. Okay, Scott, what would you do?
Great. Well, I'll share my screen here. And then I'll kind of give you my overview. So I think your sense, Dan, right off the bat is right on in terms of, long-term investment. One thing that I know David Ryan talks about is wedging patterns. And if you look at here on the daily chart, you can see that this really is just kind of a rising wedge. And I don't love those patterns. And so from a short-term trade, you could say, well, it's 30% off the low. And so, I would say the best entry for Tesla would have been this day here, because it's a clear upside reversal coming on higher than average volume. And now it's just kind of wedged into this pattern. And this is not a great swing trading pattern, especially with earnings coming up in just a couple of days. And so what I would do if I was just interested in trading this is break it down into a short-term chart. Like I'd have to stick to maybe like a 30-minute or even a 10-minute chart here. And this would really be the time frame that I would live in for this trade. If you look at the daily chart of Enphase, for example, ENPH, when it came off of its low, and I have to go back here, but
you're looking
you can
at
see,
okay, daily.
Yeah, this is a daily.
Before was a 10-minute.
Yeah, I just
go ahead.
But I want to show you the daily chart here of Enphase. And so you can see in late 2021, Enphase pulled back bigly, pulled back almost 60% from the low, and then reverted back to these moving averages. Now, remember that idea, big sell-off, reversion back to the moving averages. We look at Tesla. What do we have here? We have a big sell-off and a reversion back to the moving averages. But what Enphase eventually did is it ended up retesting that low. And so it did revert nicely to the moving averages, but then it gave you this retest, and a retest coming on a huge bullish engulfing candlestick. And so that's really what I want to see from Tesla. I want to see, okay, number one, what's the reaction to earnings going to be? And are we going to retest this $100 low? And so I would look for a potential retest of that low on the daily chart. And that would be kind of an entry where at least I can define my risk closer to this upside reversal day. What some may say is the current bottom of Tesla. So from a longer term swing, I'd want to see a retest of that level. From a shorter term swing, I'd really want to stick to the intraday time frame, something like a 10-minute, 30-minute, or hourly chart. You can see here on the 10, we have this nice sideways base of consolidation. Looks like a short-term cup and a handle. And so maybe you could start a little in this consolidation, only a few shares, placeholder position. And then if you get rewarded, you then want to see it push through that level coming on, ideally higher than average volume. And then stick to this time frame because on the daily chart, you're running up against just a wall of pain. Dan, you've talked about stocks coming out of a hose, and that's really what this is, tight consolidation, and then whoosh, everyone, especially Elon, selling on the way down. And so, one thing that you taught me a long time ago was for everyone that sold, there's a buyer buying that. And if you are buying something on the way down because you think you're getting it at a discount, and then you see it drop another 30%, guess what? You're not feeling too hot in that position. And so you're likely to just try and get your money back. And so there's built-in selling pressure with this chart right now. And so that's kind of what I see. I think you got to stick to a short-term time frame, especially with earnings coming up.
Yeah, I want to mention one thought that I had too on what you just said, as far as for every seller, there's a buyer on the way down. One way that I just thought of, just to explain this dynamic is, let's say you have 100 friends. You probably don't. Hopefully not. They're all just acquaintances. But let's say you got 100 friends and they all bought the stock in early December. And so now we've got the stock at $131. They bought it around 190, 100 of them. Now, as time, and they don't know each other. As time marches on from one day to the next, from 1 week, from 1 month, what do you think each of those 100 people are doing? Do you think they're still holding it? Probably some are, but most aren't. Do you think they all sold on the second day when the stock, say, fell down below 190? Probably not, but some did. The point is, all the way down, somebody's pain threshold was reached. And that's when you sell a stock for a loss, it is simply because your pain threshold has been reached. Now, maybe that's a rules-based thing. I always sell at 8%. Okay, well, that's your defined pain. But what happens is, as the stock moves down, one trader after another is taken out. They throw in the towel. Now, multiply that by millions. It's the same dynamic, only multiplied by millions. So what am I getting at? This is what I'm getting at. By the time that we rolled into 2023, most of those 100 people have already sold. Okay, fine. They're still kind of feeling the pain. And as you said, Scott, they want to get their money back. Well, how do you think those same people feel 6 months from now? It's gone. And people that have held the stock through all that phase for another 6 months or a year, they're not really thinking about getting their money back. They're just holding the stock. My point is this: as time marches on, that supply from regretful buyers that are still holding the stock, they've had enough time to sell. And so gradually, the cost basis of the average trader on that stock has dropped down because everybody from higher levels has sold. They've sold that was going to sell. They've sold and they've taken the loss and they're moving on. So the longer along the x-axis a stock runs after a big sell-off, the less relevant the higher prices are, because everybody's already done. Yeah. And that's why if you look at resistance from a stock that's back a year, maybe even 9 months, it's not really as relevant as it is if it was last week or even last month. And so I think it's just really important for people to realize this. And this is, by the way, what a base is all about. A base is an oscillation along a long enough period of time to where all the distribution or selling is done and all the buying has gotten to a point where they've taken in all the stock that they can at these lower levels, and now they have to start reaching higher to buy the stock. We are a long ways away from that in Tesla. So anyway,
Definitely.
sorry I jumped on your riff.
No, I think you're right on. And again, going back to end phase, that's what it took here. After this big sell-off, it wasn't just straight off the bottom. There were ebbs and flows. Oh, it's really high here. So anyone back here is like, oh, finally, I got my money back. And so it's the ebb and flow that I want to see Tesla start to do, as opposed to just kind of wedge off of the bottom here. So that's what I got for you today, Dan.
Okay. Rocky, what do you got? We were talking beforehand, and you can go ahead and take the screen if you want. You certainly don't have to. Doesn't matter.
Let me. All right. In my particular scenario, I couldn't agree with the two of you more in so many ways. As I was doing some research on Tesla, you look at really where the support levels are. And it was interesting that it happened to have bounced off of this about 108 level. And right now I view Tesla in the middle of this box that I've kind of created here. This is the resistance level on the upside. Yes, it's a little bit below the 50-day EMA, but I'm finding that it's going to end up really running into some resistance on the upside. And so really, it's kind of in no man's land from my point of view and going forward. And so when you have very little upside potential, here we are at the 131, 132 level here today, and the top for me is 143. That's not even, that's a very minimal risk to reward, because the downside is from this 131 level all the way down to 100. So you've got a 30% downside risk with really less than a 10% upside gain before you're going to hit either resistance up the top or support on the bottom. So I, like the two of you, feel that it's something that you just want to stay away from. There are better places to end up putting your money. There are stocks that are working at this particular moment. And while you may be a Teslonian and like Tesla, right now, I think you might like your money a lot more than you like Tesla. So in order to keep your money, I would stay away from Tesla. If you were absolutely determined to end up taking a trade, there are ways to end up taking a very small risk option trade going into earnings. I would not put either one of these particular trades on until the day of earnings. And I'll show a couple of ideas. One is called an iron condor. And what I take a look at with this iron condor is the first thing you want to take a look at is, what do the market makers expect the market to end up moving between the time that you take the trade on and the end of that particular expiration week, which of course this is, it reports on Tuesday of next week and the end of the week is on Friday. Right now, they're looking at a 12.5 point move on Tesla. So either 119 on the low end or 143 on the high end. And you can end up setting up an iron condor. And I would not suggest doing this at all today. And I'm not really comfortable with this trade because Tesla has a tendency to exceed the market maker's move based upon my history with Tesla. And so I don't take I don't take an iron condor on Tesla because see, your risk on this trade is $201 versus a $98 profit. What I've done on this trade is I've gone outside of the potential market maker's move. 131 minus $12 brings you down to 119. You could go to 118 if you wanted to, but I'm not really interested in having it that close. So I went to the 117. On the high side, you take 131 and you bring it right up to the 143 at this particular juncture. I, again, would do it to 144. So here, and then you have to buy protection because you don't want to sell naked. You want to end up having protection in case it does exceed the market maker's move. You're pulling in $116. You're risking $282 on a stock that I would not. I do not want to end up risking one to make two on a potential binary trade. So that's one way to do it. One other way to end up doing it, and this would be my preferred way of doing it now, and that is you do a broken wing unbalanced butterfly here. I could show you, you buy the 140s here. And again, you're going not quite out the market maker's move that way. By doing it this way, you're trying to take advantage of the fact that this market maker is going out to 143 as far as adding 131 plus 12 is 143. So you sell 3 of these particular legs going out to 143. You buy something that you're looking for in the money, you sell 3, and then you buy 2 as protection. So your total risk on this trade, if you were bullish on Tesla, is $32 on this trade, and you have a potential profit of 268. But that doesn't end up working out unless all of the things arise. But this is a much less risk than even an iron condor. And then if you feel that you wanted to end up being covered on the bearish side, you could set up this same thing with the same type legs on the bearish side.
Hey, Rocky. Hey,
yep.
let me interrupt you for a sec. I want to hear about that, but I want to clarify some things because this, I'm not really good at, I just don't have a lot of experience at this style of option trading, but it frickin' works for you. I've been watching you do this, and our members, the same thing. I mean, you're making great money with this strategy without risking a lot. I mean, risking 34 cents to make, what
267
200. Yeah, I mean, it's a huge deal. Is it always a 1, 3, and 2 where you buy one closer to the price? You buy the lower call, then you sell 3 higher strikes, and then you buy 2 that are 2 calls that are just above that, kind of like we're seeing here. You buy 140, you sell 3 143s, and you buy 2 144s. Is that kind of the typical structure?
For me, on an options trade, if I'm going to participate, yes, that is absolutely the structure. And what I do is I also do it on the other side as well. I originally had done it where, okay, I was bullish on Tesla. I'm just going to end up taking it on this side. What I found out, though, is if I take the same idea and put it towards the put side, I can enter the put side for about the same price, 31 cents. So my total investment is about 60 cents or $60 on this. And that way, if I'm wrong on the move, because let's say I am bullish, if I'm wrong on the move and it does end up going down, then I have a very good chance of being able to recuperate that trade. In fact, I did this on Netflix last night. I had I had 40 cents in my Netflix trade for both sides. And I ended up selling it this morning at 62 cents. So
Nice.
on the call side. So it was a 50% gain. I don't put that much into these, and wouldn't suggest anybody else doing it. But this is a way. And just I'll show you how you can set it up. And again, you'd only want to set this up the day of earnings that are going to be reported. You always want to take into consideration what the market maker's move is. You end up buying the long call within that market maker's move. You sell the short calls, the 3, just at the market maker's move, and then buy 2 just above it as protection in case you're wrong. Okay. And that's the same thing on the downside. Let me just clear this off and we'll say, okay, on the downside, we've got 131 minus $12 ends up being 119. So I'm going to say to myself, okay, that's where I'm going to sell the 3. I want to end up being within the market maker's move. Let's see if I did the 122, sold 3 of the 119s, and then ended up buying for protection the 118s. Then I need to buy 2 of those. Oops, let's do this. And here we are. And so that's 34 cents, 33 cents. So the total for these 2, as far as having both a long position and a short position, is 60, about 60 cents or $60. And your potential profit ends up being about $270. Ultimately, you can end up getting out of these usually for about a 50% gain overall. So in this case, it'd be about 90 cents is what you're looking to exit that for.
Okay. That's pretty good. By the way, if anybody's watching this and your eyes have glazed over, don't fret not, I'll say, because I've already talked to you, Rocky, maybe next week, but certainly within 2 weeks, hopefully next week, we're going to do a webinar that I'm really I'm going to hammer Rocky on this and make him explain every damn part of it so that by the end of the webinar, you're going to be able to understand these broken wing butterflies. We have a butterfly sanctuary not too far from here. That's true in Kodo. So I can't do the broken wing butterflies without feeling bad. But I want you to explain this, Rocky, and then also explain the wheel strategy that you've been using a lot. So hopefully we'll get to that next week. But if you're interested in options at all, I really think you should get into that webinar. So if you're a member, you know how to do that. You can subscribe to Option Market Mentor for $88. That's a special price now because we're just starting to get it rolling. After we get it rolling, I think we're probably going to wind up charging $150 a month. So if you want to get in before the open house and help us clean up a bit, you can lock in $88, which to me is a good trade. But then you can get in on Rocky's webinar because we're going to be doing that next week. So I want everybody, I want everybody to make money, and that's why I'm starting to do these podcasts with Rocky and Scott. Trade that stock. We can pick basically any stock as long as it's topical, and then we'll try to figure out if there's a trend trade, fundamentals plus trend, if there's a swing trade with Scott or an option trade with Rocky. So there's really something for everybody here. If you liked this, let us know. You can email me at dan@stockmarketmentor.com. That's like my personal business email, or you can post it in the forum if you're a member. If you're not a member, I don't know what your problem is. You need to be. Okay, that's it. Guys, are we done here?
Yeah, great session, Dan. Great first
Yes.
trade that stock. It was a lot of fun.
Yeah, it was a lot of fun.
Yeah, guys, thanks for helping out. I appreciate that. We're going to do many, many more of these. Okay. All right, everybody. Have a good day.